Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Welcome back, everyone. I am your host, Scott Henderson, and my co-host is Dr. J. We're glad to have you on this week. There's been a lot of questions floating around, and we've had several of you reach out, which we appreciate. Ask away. But Jason, we have had a few questions that people have asked. Let's talk about those today, and let's get into the nitty-gritty.
Okay, let's do it.
So one of the first ones that I have, and that we've seen quite often, is how do you decide how many policies to open? We love the infinite banking concept. We love what it does. Now let's get some application here. Like, do I just do a big one? Do I do little ones and open branch offices right away? What would you suggest?
Well, I often tell people there's a couple of things I say. One is I say you want to put as much as you can, as fast as you can, for as long as you can. And I know that really doesn't answer the question. The other one being most gurus, and if you take something, say, from the richest man in Babylon, it needs to be between 20 and 30% of your annual gross income needs to be premium. And that's the starting point, right? If you understand really what Nelson Nash was talking about, he says that your whole income should be going in as premium. So there's a wide range there. Now, do can people do that to start off with? No. Do I have clients? Did I start with a smaller policy and then build up? Yes. Often that's the case. Start where it's comfortable for you, for the fact that the most important thing is that you have a policy in force. Don't build this great big policy and realize down the road that, oh man, I'm unable to make these premiums and have to surrender the policy. It's going to feel like you lost money, and you're going to be mad at the insurance agent. In fact, I got a buddy up in Pocatello I went to school with, and he got excited about the infinite banking concept. He had so much money in the bank, and the guy says, "Okay, we're going to put this here, the first two premiums that you have." Well, guess what? Come third year, he didn't have enough to do it, and he basically had to surrender the policy. Again, he lost money. So those are some general guidelines, right? Now, when someone has maybe a big sum of money, and I have a book called How to Use Infinite Banking to Supercharge Real Estate Investing. In that, I tell people, give them an example. If you have a big chunk of money, say $100,000, you need to be thinking in your mind that ongoing premiums, so it passed the smell test, if you will. So it looks and smells like a life insurance contract and will have the tax advantages. You need to be able to do roughly 20% of the big number. So if you have 100,000, then you need to be doing 20,000 for the at least the next 7 years. And then it can go down from there. Hope that answers the question.
It helps out somehow. So part of what Jason's saying is like we want to get you into something as much as you can, but we need to do it strategically. We eventually want to build up to your entire income because once you understand that, that's going to provide you the most benefit and get you out of the system. But like Jason said, like 10, 20, 30% is a great place to start. And grow from there. It's not like a one solution fixes all, correct?
Correct.
Cool. All right. Question two. What's the strategy behind premium amounts and frequency? Is monthly, annual, or like a lump sum? Which is better?
So let's talk first between monthly and annual. There is a little bit of bang for your buck, if you will. There's a little bit of a it's better to do it in lump sums annually than it is to do monthly, right? The premium is due on your anniversary. And so, in a sense, when you do it monthly, you have borrowed from the insurance company to pay that premium at the year anniversary. And then you're paying them back principal and interest over the year uh, to get that back. And so, there is a little bit of bump to that, being able to do it annually. However, really, it's not huge. It's only about 5 or 6%. For some people, that's enough to say, okay, I'm only doing it annually. There was another part of that question. Remind me.
Yeah, or a lump sum. Like I'm thinking that they put a big chunk up front and then don't fund the premiums, like what we were talking about in question one.
Right. Well, and I kind of answered that already. If you're going to do a lump sum, you need to be thinking that roughly 20% of that ongoing. So let's say you're sitting on 100,000. Again, 100,000 now, that's the lump sum. Ongoing, you need about 20,000. Well, what about breaking that up into two equal 50,000s, right? And then ongoing would be 10,000. And that might be more affordable for people. So, yeah, you can put a big lump sum in it and you should have access, 60 to 75% of that should have access to it, sometimes a little bit more right away. So you could start being your own banker with that amount of money.
Cool. All right. So, question three, how do you track your internal rate of return across policies? And should we treat them like an asset in our investment dashboards?
Well, the cash values, I certainly, in my personal balance sheet that I update on a quarterly basis, I track my cash values. I'm not tracking the death benefits, and I have 10 policies. I'm not tracking any of the death benefits, but I know what the cash values are. Now, as far as internal rate of return across policies, you can easily calculate that by getting an in-force illustration and look at the increase. You've made a payment, it started here, you made a payment, and this is what is in year end, and you can calculate it year over year. That's pretty simple to do. However, the question is coming from someone that may be misunderstanding this whole process. This is not about a rate of return. Okay. This whole concept is about how you finance things, not the rate of return that you're getting inside the policy. I'd agree with, some of the financial entertainers out there that inside the policy, it's competitive, but it's not anything to get super excited about. What I'm excited about is how I can use those cash values to finance properties. What would you say our cash on cash return is on that fourplex up in Pocatello?
Oh, when we bought it, I think it was 30 or 40%,
All
wasn't
right.
it?
It's been a great investment, right?
Mhm.
And month over month, as it's paying, out, if you will, dividends that we're using, that whole thing was made possible for the fact that we had a life insurance contracts that we could get access to money right away. I know you did a deal just recently. You may not want to give all the details. However, you're probably going to make 10% on your money in a few short months, right? That's made possible for the fact that you have access to capital. And the best place to store that capital is inside the insurance policy. So the internal rate of return, again, this is not about what's going on inside the policy. It's about what you can do with the policy and what you can do with that money outside the policy. Hopefully that answers it.
I agree, but let's dig in here. Okay. What is the rate of return in the policy? In general, speaking in general terms,
Well, the insurance company, the insurance companies, the insurance industry was allowed by Congress. They passed a law to be able to lower the interest rate that they promise, right? The guaranteed rates are going to be low. They might be 2 and 3/4, might be 2.5. That's income tax free. So I mean, if it's 2.75 and you're in a 30% tax bracket, that's almost a 4% rate of return equivalent, right? However, when you have the right type of insurance policy company, and we've brought this up before, you want a mutual company. There's stock companies and there's mutual companies. Stock companies is obvious. It's owned by people that own the stock of the company. The mutual companies, though, are owned by the policy owners. So that particular policy is actually getting two types of growth. There's the guarantee that I said, it's about 2.75%, 3%, 200%. It's going to vary from company to company. Now, the non-guaranteed growth, and the only reason it's non-guaranteed growth is because you're getting a portion of the company's profit. Whatever your percentage of the company is, so to speak, you get your portion of that company profit. Well, what's the profit going to be in 2026? No one knows. That's why it's not guaranteed. You're guaranteed to get your portion of the profit. And so that can be, I mean, over my experience in this, I mean, they have been as high as 7, 8, 9%, as low as 2 or 3%, right? It's been different times at different times. So
well, I
it really
think too,
depends.
like when we average it or look at it, we're usually taking a 4 to 5% overall pre-tax. right?
income tax advantage or income tax free, right? That is not being, there's no, in order to do that, you take your tax bracket and you could calculate what an equivalent rate of return would need to be, say in the stock market or someplace else where you pay tax and then you keep what's left. But yeah, it's right along there.
Somewhere in there. And then once you layer the tax benefit, it could be as much as 7, 8%.
Yeah,
And so we always play with the lower numbers we like to be conservative, but people like to know that thing is that's a huge advantage. I mean, a compounding rate of return at 7 or 8% over 30 or 40 years, like your 401k won't do that. Not to mention, like we can go on and on and on about how the 401k does this and that. And so, really, that's like the base. Because there's the second portion to this is they want to know what the internal rate of return. Well, let's take a step further. If you're treating it how we're telling you, and you're getting a base rate of, let's say, 5%, and now I'm going to go buy a property that's paying it back, and then I'm going to go buy and invest in hard money that's paying it back, what exactly is that? You know, it becomes infinite. It becomes this cycle that goes on and on. And so the way that I personally look at it is I've got a base rate of 5%. When I go get another property, it adds anywhere from 4 to 5% additional rate of return on top of whatever I'm calculating. And so that's where the rubber really meets the road is when you look at this in multiples, because you got to look at it in three phases: base percent, investment that I'm using, and then the me doing it several times. Not to mention that you get tax advantages from this as well, correct? If you're doing
absolutely.
an entity strategy or whatever, interest is deductible off of your taxes.
Yep.
Okay, so a lot of agents out there, they don't like this concept. One, because they don't get paid very much to teach someone to do it, and two is is it also prevents people from using policies that aren't advantageous for the owner, correct?
Yes.
So then, is there a certain amount that you would consider safe as a if you were to take out a policy loan versus something else? Or what is I know you have internal rules, so share some of those things with us.
Well, I'm a disciple, if you will, or follower of Nelson Nash's whole concept in his book, Becoming Your Own Banker, that I think is one of the most significant financial books anybody can ever read. Now, in there, or when he would do his seminars, he said there's really only two things, and that is don't be afraid to pay massive amounts of premium. And number two is don't steal from yourself. Now, when you take a loan and you don't pay back on that loan, at least the interest, you're essentially stealing from yourself. And when you do that, regardless of how much of a loan you take out against your policy, whether it's 20% of your value or 94% of your value, it doesn't really matter when you are being irresponsible and not making payments on that loan back to the entity that you own and control. For the fact that you continue to do that, the entity is going to die, right? And it's just going to go out of business. I mean, any bank that's the case, if it has a whole bunch of non-performing loans, it's going to go under. And it's the same thing here.
I love that. So that doesn't answer a question. What is a safe amount to pull out if you're going to do a loan? Or is there a safe amount?
Well, there is an answer there, Scott. I mean, it depends on how you behave. It's your behavior that's the most important thing. If you take out a 90% of your cash value, that can be safe as long as you're making payments on that loan over time. When you don't make payments, 90% is not safe. I would say 20% is not safe. Whatever is safe is the amount that you can continue to make payments on that back to the insurance company, at least an interest payment and your premium.
Perfect. And my perspective is I'm a little bit different. Okay, because I'm investing in stuff that cash flows back all the time. We both do. And so that's not as big of a criteria for us per se. So if you're like us, the way that I look at it is I want cash in there of at least one premium payment to cover all of my policies. Because that way, if something happens and I don't have access to liquidity, I can continue this cycle. So
Okay, I like that. That's a good measuring stick.
there's a few ways to look at it because also once they age, if that's all you can do is just put that in there, it'll naturally grow because it's hit this certain point, right? This certain inflection point.
That's right.
To go along with that, what criteria, what's your criteria on taking out policy loans? Do you treat it like a personal line of credit or only use it for investment arbitrage? Like how do you look at these policies in general?
I would say both of those. I look at it as a personal line of credit in the event I want to do something, and I also use it as the ability to arbitrage it with an investment, right? And it all depends. I mean, some people argue, well, I'm paying the insurance company like right now 5.75. Well, I can get a better interest rate at the auto dealership down the street. You might be able to. However, you have structured payments and regular payments. Any hiccups at all, they come out and repossess your car, your credit's dinged. When it's the insurance company and you're the owner, you might be able to take a holiday for a month or two or three. As I had several clients and even myself during COVID when people couldn't work and things were kind of shut down, it wasn't required that you had to make a payment on your loan. However, when things started back up, you start making some payments. So I think part of that criteria, Scott, is do you want the control? Do you want control over how and when you make the payments? Or do you want to chase some interest rate that may or may not be less?
Well, I think that's a valid point. And I think what we do and what you've always taught me is talk to them about Coca-Cola, the opportunity cost.
Are you talking about EVA?
Hmm.
All right.
Because
Well,
that's how I determine things, even in different investments, because I've got hundreds of investments every single day that get presented me, and that's how I sort through and decide what I'm going to do.
and what you're looking at though is the cost of capital, right? If I have an investment that's going to give me 25% rate of return every single year, and my only ability to get capital is going to cost me 15% per year, is that a good deal? Well, of course, right? The 15% is simply the cost of the capital. And so that is one way of looking at it. It's okay, my cost of the capital is 5.75 or 5%, five and a quarter, whatever it is from the insurance company, right? As long as whatever I'm going into is a higher amount and I can arbitrage that, then I'm good to go, right? But again, if I'm taking a 5.5 and 3/4 loan or 5% loan and I get a car loan, but I could get a car loan for say 3%, well, then should I just go do it from that entity? You might want to, maybe. Again, you have structured payments and the interest is going to someone else. Where when it's a mutual company, the interest that you are paying to the insurance company, and it is going to the insurance company, is going to a company that you're a part owner in, and you get a part of the company profit.
And so I guess it depends. And I've taken it a step further. When I look at what I'm going to pull out, I treated it with different hats. I'm getting a loan at market rate. Well, I know I can raise capital at say 10 to 12%. So that is the rate of return that I'm paying this entity back with. So at a minimum, I've got to make a spread from there to live on what I need. And so that's the way that I look at it is my opportunity cost is like, hey, yeah, that loan is 5%, but I'm not going to have a business where I'm breaking even. I'm going to have a business that needs to make money. And so if I write it at call it 10 or 12%, and then once I get the money, I can make 18% or 20%, then all of a sudden that's how you look at it is like your actual rate of return at 20% might be 15% between the two, but then it's structured between two entities. And so you really do need to take time and look at it. Because for me, if I could get a car loan at less than 5%, I wouldn't take it. I wouldn't take it from my policy because I know I can get a better rate of return and I can pay off that car whenever I need to. But for someone who's first starting, it makes sense to build your system. And I think that's what you're getting at, correct?
Yes. Yeah, it's all of the control and where it's going and how, where
Right.
the money is actually going. Is it going to someone else's pocket? Is it eventually going into your pocket? And sometimes that difference in interest might make a big deal to you. And really the what this is boiling down to, Scott, is I think that whoever's asked this question is you need to have someone who knows what they're doing, someone that can coach you and guide you through that, right? To bounce this very question off. And like you said earlier, it's not a one size fits all. It might highly depends on what the scenario is and what are the ability to make payments on that, right? Can you go a whole year and not make a single payment on a loan that you take from the insurance company? Yeah, you can, right? Do you want to continue doing that? No, you don't. However, if you put it into something, say, yeah, we're not going to get any money back out or return for, 6 or 12 months or something, it might be worth it to do it, even though it's a higher interest rate than what you can get from someplace else for the fact that you are unable to make the payments in the meantime.
I like that. So one of the things you're gifted at, Dad, is you are gifted at improvement, improving upon what's already been built. Right? I mean that's what you did as a chemist. You took the foundational knowledge and then took it into the future, into the unknown. And so you've been doing this 23 years now, give or take a little bit. Over that period of time, what have you seen that could make these loans or the policies more efficient?
More of them. Uh, it, just like a bank, that when someone going and deposits money in that bank, right, they want to lend that out as fast as they possibly can, right? It's a thing called the velocity of money, the money movement. It's money in motion makes money, right? And so I think one of the things that we could do as a family is be able to find deals and turn money. You know that from hard money, right? If you have someone that giving you a line of credit that you've raised money to then lend as hard money loans to people, the faster you can turn it, the more you can make. So if you can do, two loans at 3 months each in 6 months versus one loan at 6 months, you're going to make more money. And the banks do the same thing. That's why they entice people to do 15-year mortgages instead of 30-year mortgages because they're turning their money twice versus once and during that scenario. So yeah, I would say that. Where would you say is possibly a place to improve efficiency?
I don't know. That we've done it for so long. I mean, there's things that I would like to suggest to the insurance company to do. Like we were talking, for example, that other day about an all-in-one loan. Why in the world could we not do that with a policy rather than a real estate backed asset?
Possibly.
But that what it would require is just the policy has to automatically be linked to the bank account and have automatic withdrawals back and forth. And so what you'd really need is for that insurance company to also be a bank. And that way that's how we do it. So that's one thing that I would be all over.
Yeah,
Simply because my reserves, like let's be honest, it takes 24 to 72 hours, which isn't long, but the effort of having to go in and do that rather than having it done automatically would be one that I would, if we could get one of them to just look at it, would be super helpful. And not to mention, they do underwriting one time and it would take away several of their jobs, making their company even more efficient.
right. There is a really big distinction though between banks and insurance companies. We throw around the idea of infinite banking concept inside of life insurance. Life insurance companies do not like the word bank because there's laws that separate the two. All right. And so kind of what you're describing might go against that. And that might be one of the reasons there'd be a lot of resistance, but we can always hope. You never know.
Yeah.
Insurance companies are notoriously slow in their movement.
Well, that's because of their timeline, right? Their timeline's 500 years out,
Yeah,
100 years out.
they're
Like
thinking in decades by a long
they're
shot.
not
Yeah.
thinking about tomorrow or next month, or they're way out in the future.
Yep.
Um, are there any policies that we should restructure? Maybe do a 1035 exchange or repurpose for better leverage?
Absolutely.
What would you say?
As you said earlier, 23 years, it hasn't been quite that long, but in almost 19 years of doing this actively, right, as being an agent and teaching other people, I have yet to see a universal life policy that doesn't collapse. And I don't care if it's a VUL, UL, IUL, EIUL, VIUL, whatever it is, and any other new concoction that are going to come along. Every single one that I have seen, when you look at an in-force one, so one that's been in force, someone that's had it for a while, they all crash. They self-cannibalize, they eat the cash value up, and then there's no death benefit and no cash value when people are getting to that time frame when it might be very useful for him. I have never sold one. I don't plan on ever selling one, and I most likely would never buy one either.
Well,
Right?
this plays to a fundamental nature of humans, right? Fear and greed. They're the different sides of the same coin. And so when an agent sells something like that, I've often seen it that they're applying, hey, this is really cool concept. Let's just make it better in this way. Here's the greed side of it, correct? Because they're always pointing to look at what the non-guaranteeds are here. Yeah.
Well, yeah, and they can illustrate non-guarantees at essentially an unrealistic amount. They may be illustrating it at a say 6-7% rate of return every year. Well, that's net. That's a net return that they're showing there. And those things are full of fees. There's full of problems. There's up years. There's down years. It's just so unrealistic. And like I said, as it plays out, I have yet to see one that doesn't collapse. In fact, I got an email, a random email, some guy attempting to say, "Hey, I can help you with your business," like we all get all the time, right? He says, "I have a place where you can, it's an easy sell. All you got to do is you find people 65 to and older that have not gotten an in-force illustration of their UL policy. Get them to get an in-force illustration, and they're going to see it collapsing. It's going to be demonstrated in the paperwork, and those people will want to get rid of it as fast as they can. And all you got to do as an agent say, okay, well, we can move you over into this annuity or this or whatever. And it's falling off a log to make that sell. Well, that is telling you that that's a problem out there, that people are having that problem. And the reason is because how the policy, the UL, the whole universal life policy, how it's designed, it's flawed in its ability to be there for your whole life and to always have guarantees. In fact, it doesn't have guarantees.
But that goes back to really the fundamental value is that you're running on a treadmill going backwards, trying to go faster and the treadmill's coming forward. And that's the term rider that is attached to a UL.
Well, the one year renewable term, yeah.
So that's where the fundamental issue is. And that goes back to like a core principle that I always use when I'm investing. What's my worst case scenario here? When I'm doing hard money, part of the reason I love it so much, my worst case scenario, I get the property. And most of the time, I'm getting the property at 70 cents on the dollar or less, right? That's my worst case scenario. And then I go rent it and I know exactly how to play it. My best case scenario is they perform and I'm making 12 to 14, 15% plus my points. So either way, I win. And that's really how it ties back to this is like I'm more concerned about losing on a UL than I am about the greed side of the coin. And that's where people need to take time and say, hey, we need to stop. What could happen here? And that's where the whole life policy really comes up and really shines is this is designed to be enforced your entire life, whole life policy. And once you have that, then you can add on top of it. Because remember, this is like a solid foundation you're building on. This isn't the investment vehicle. So keep that in mind next time you're pitched on one or the other.
Absolutely. And if you have questions, contact us.
Um, all right. Well, we're getting to the end of this. We've got a couple more, but I'm good. Let's do one last one.
Okay.
How would you see these policies integrating with our estate plan or our family trust structure long term? Like, what is the play here? What is it that we're trying to accomplish? And let's think out 100, 200 years from now.
Well, the trust, if you will, the family trust will be the beneficiary of the death benefit. And all that income tax-free money will go into that. And that will then be seed money for the next generation to do whatever it is they need to do. Instead of going and getting a loan from Uncle Sam or someone else to go to college, they should get a loan from the family banking system. When they get done, they need to be required to pay back that loan to the family banking system with interest, just like any place else. But the interest is going to be captured by the family so that the next person that comes along will be able to maybe do a college education or start a business or whatever. And what happens then is that is also money that would then be buying policies on the next generation. And so what would happen from generation to generation, because there's a step up in basis all the time and a step up because the amount of premium put in is generally a lot less than the death benefit. And so that death benefit being created allows us to make it bigger and bigger and bigger from generation to where now you can start bringing in other things and say, okay, well, maybe the trust can own this business, or maybe the trust can do that or this property, right? It's a core part of the whole structure. Now, there's another thing that it's maybe a little bit beyond this podcast, Scott, but that when you talk about the whole Rockefeller structure, a whole life policy is in there to help strip or equity strip away from assets that you have so that you become less and less of a target for a lawsuit. But there's man, the answer on that one could probably be the whole podcast, but hopefully that's a good enough answer for now.
Yeah, what we're getting at in this concept, again, is not the return. It's the access to capital and how you're accessing the capital. Because when you're passing it on to generations, you don't want to pass on hundreds or billions or millions or whatever it is of dollars directly to your kids. It will hurt them. I mean, you look at the Vanderbilts. They didn't even make it 3 generations, and he was the wealthiest man on earth at the time. And so what you want to do is you want to build a system that forces them to learn and be responsible and forces them to also think about the next generation. And that's something in the scriptures all the time. The hearts of the children turn to their fathers and the fathers to their children. And if that's something that we can incorporate into your family, all the better. Because again, you are doing it it's not just for them, it's for you as well. And so, but keeping your mind on them helps you make different decisions now that will protect you in the future. So, well, we're wrapping up here. Jason, any final final sayings that you'd like to put out there?
No, I don't think so. This has been fun. I appreciate people are liking and giving us 5-star review and subscribing and everything, and yet also sending in some questions like that. We really appreciate that.
That we do. Thanks for tuning in, guys. If you liked today's episode, make sure to leave us a 5-star review. It really helps us out with the system. If you want to talk to us, hit us up on any social media platform of your choosing. Shoot us an email. All the links are in the show notes down below. And last, remember that mastering your millions all starts with your mind and your team. Make sure they are the best. We will catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.